A trader often encounters too quick losses, leading to an overwhelming desire to recover immediately. The trading screen transforms into a reflection of identity, causing decision-making quality to plummet as pressure mounts. This cycle intensifies when losses feel personal, shifting focus from the process to mere relief. When the pursuit of relief becomes the priority, risk escalates, exits are postponed, and minor mistakes quickly multiply. The true impact lies not in one single losing trade, but in the detrimental habits that emerge afterward. Over time, confidence can become fragile, and each new position starts to carry the burden of past regrets. A more effective approach begins with separating analysis from emotion and establishing rules that remain intact under pressure. These rules should encompass trade selection, position sizing, exit strategies, and knowing when to take a break for a reset. In the following sections, we will explore the patterns, advantages, risk controls, patience, and mindset adjustments that elite traders employ. This video draws inspiration from The New Market Wizards by Schwager, so be sure to subscribe for more practical trading insights. Price movements are primarily influenced by human reactions to fear, greed, and uncertainty, which often manifest in similar ways. Since these reactions tend to repeat, recognizable patterns can emerge even when the surface narrative appears fresh. No single indicator can solve every problem, as market conditions frequently change, and simple formulas can become outdated. A viable edge is a consistent advantage that aligns with your market perspective and decision-making style. For instance, one trader may delve deeply into fundamentals, while another relies on charts, and both can achieve consistent success. The essential factor is proving that your method yields positive results over numerous trades, rather than relying on a single winning streak. Significant progress often stems from altering your habits rather than simply acquiring new tools or making predictions. This requires recognizing how impatience, pride, or fear may divert you from adhering to your own trading rules. Once your edge is identified, every trade should become a test of execution rather than a quest for certainty. The goal is not to be correct every time, but to apply a reliable advantage and embrace uncertainty daily. A trading strategy fails when it requires a temperament that you do not genuinely possess under real-time pressure. If you struggle with relinquishing gains, a long-term trend approach can compromise your discipline at critical junctures. If constantly monitoring the screen exhausts you, a fast-paced trading style will likely lead to errors caused by fatigue and impulse. The aim is to develop a method that feels natural, as comfort fosters consistency, and consistency leads to results. An edge must involve clear criteria for entry, well-defined exits, and a rationale for why the setup is likely to succeed often. Creating that methodology involves extensive research, careful observation, and navigating many dead ends before establishing a reliable strategy. During execution, effective trading should instill a sense of calm because the groundwork was laid prior to placing the order. When trading becomes a struggle, it usually signals that the strategy is unclear or the position size exceeds your comfort level. To get started, document your trading method in clear, actionable steps and rigorously test it through various market conditions. Make necessary adjustments until the rules align with your personality, while ensuring that the results stay positive, even when accounting for costs and potential losses. Effective money management is crucial. A solid strategy can still falter without careful control of risk. A practical guideline is to limit the risk of each trade to a small percentage of your total capital, usually around 1 or 2%. Always set an exit point before entering a trade to prevent emotional decision-making from altering your plan mid-trade. After hitting a predetermined drawdown, take a breather and re-enter the market only when you feel assured in your strategy. These risk limits eliminate the urge to gamble because you know your worst-case scenario is manageable and acceptable. Trading driven by fear leads to hasty decisions where each market fluctuation feels like a threat to your financial security. A wise filter is to reject positions where the potential loss could disrupt your living essentials like rent, food, or relationships. A well-structured trading plan connects your method with these risk management rules, preventing the need to reinvent your strategy daily. With a solid plan, losses transform into valuable information for analysis rather than signals for panic. If safeguarding your capital is a priority, commit to developing risk management habits that ensure your longevity in the market. Many top traders view trading as a waiting game, understanding that most times yield mediocre opportunities. Their focus is on identifying moments where the odds and price dynamics create a uniquely favourable setup. In practice, this may involve periods of inactivity followed by decisive action when conditions are right. The most challenging skill to master is enduring market noise without succumbing to the compulsion to trade out of boredom or anxiety. Accepting that it's fine to miss the final part of a move is vital. Capturing the middle often proves to be highly profitable. Adjust your position size based on the quality of the opportunity, ensuring that high potential ideas are given greater emphasis. Employing techniques to scale in and out can mitigate regret, as part of your position is safeguarded while allowing for further gains. Taking partial profits can secure your progress while still giving you the chance to benefit from extended trends. Track your trading outcomes to see how often patience led to improved results compared to impulsive entries. Over time, practicing restraint will become a powerful advantage, as fewer trades can lead to more thoughtful decisions and reduced errors. One common pitfall is the mindset of needing to win, making effective risk management seem optional. Another trap is clinging to losing trades to avoid admitting mistakes, which can escalate a small loss into a significant one. Embrace small losses swiftly, as resisting them usually invites even larger losses down the road. Hope becomes perilous when it replaces critical analysis, encouraging you to remain in positions without a sound basis. Protecting your capital may necessitate designating certain price levels as off-limits and exiting trades decisively without negotiation. Build your confidence on trust in your method, rather than seeking validation through proving your intelligence to others. Confidence allows you to cut losses more easily, knowing that the next opportunity doesn't hinge on one trade. When emotions run high, taking a step back can restore your judgment and help avoid revenge trading after a setback. The objective is to achieve independence, where your decisions stem from your established rules and not from headlines or societal pressure. Adopting this mindset turns losses into manageable costs of doing business, rather than threats to your self-worth. A resilient trading journey begins with embracing uncertainty and refusing to view each trade as a referendum on your abilities. Patterns exist because human reactions are consistent, yet the specifics change, so it's essential to continuously learn. A trading method that aligns with your personality fosters consistency, and that consistency helps reveal whether you truly have an edge. Risk management rules are crucial for protecting your account, ensuring that one mistake doesn't undo years of hard work and learning. Patience enhances your selection process, while sizing and scaling allow your best opportunities to make the most significant impact on your results. Maintaining psychological discipline keeps losses small and prevents your ego from turning ordinary fluctuations into crises. Regular review periods help distinguish between bad luck and poor decisions, ensuring your adjustments remain focused and effective. Over time, the process simplifies, as fewer rules become significant and each rule undergoes rigorous testing. The ultimate reward is clarity, empowering you to know what actions to take, what to avoid, and when to step back. Subscribe for more practical insights that intertwine edge, risk, patience, and psychology into a cohesive routine.